Good day. This is the Eye of the Storm podcast with the big picture technical update for the U.S. Treasuries. And today I will delve into the 30-year bond future and yield, the 10-year note and yield market, futures and yield market. I'll take a look at the 5-year and the 2-year futures market. So I'm going to start here with the 30-year bond. And I'm going to start on the weekly chart. Now, the big picture does continue to show that I don't necessarily count this, by the way, because I think that was an anomaly on one day during the pandemic, at the sort of the top end of the pandemic, when it kind of got a little scared and it went pop. It never has come off, so I'm taking that was a valid price, but I feel that the orthodox top for the bond market came in August. And therefore, that's where I mark primary fifth wave, completing right there at that top. And that level was 183. Actually, it was like a little bit lower. Yeah, no, 183.06. And right now we're dealing with a 30-year bond that's being priced at 112.31. So quite the difference. The interest rate when it was up there at that 183 level was 1.17% for a 30-year bond. You got 1.17%. And so since then, the bonds now, last week, the yield in the 30-year bond snuck and just kind of spiked real quick above 5%, and currently just rests below at about 4.75%. So in a 2 years' time, 2.5, the market has gone from 1.17 to 5. 4.75 to 5%, and with the feel that the market will go between 5 and 5.5. Now, what I have been counting off of that primary fifth wave top is the formation of the initial 5 waves down, which would then complete an intermediate A wave. So on a longer term basis, I'm looking for, again, in the bond market, I don't necessarily go above a primary degree. I think because the bond market is more secular in terms of high and low and et cetera, that to really try to construct like we do in the equity markets, an extremely long-term picture does not exist as well in the bond market. So because they're only 30-year bonds, 20-year bond, 10-year bond, et cetera. So, the whole cycle in each tranche that begins is either 5 years, 2 years, 2 years, 5 years, 10 years, et cetera. So we go all the way down to Treasury bills, which are anything under 2 years. And then we're dealing with a much shorter time frame for the whole life of that particular T-bill or that particular bond. So going above and beyond a primary degree, I think is kind of not necessary within the bond market. So primary 5, I'm kind of labeling it right there. And that really is coming off of the lows that were reached after in 1981. So we kind of got to do a primary, and that covers a lot more than the 30 years, but we had several tranches in between. Okay, so coming down in this initial 5 waves down, I have minor 1, 2, 3, 4, and we've been involved in this minor 5th wave down since the beginning of April. And while on a weekly chart, I'm still leaving open the potential that we have one additional slide lower. And as I drop down, you're going to see how I'm connecting all the dots there. But the alternate that I'm really working with, and really does carry a higher probability of actually being the case, is that the bond markets and the Treasury markets, I should say, have put in their intermediate A waves low. And so they're done with this initial 5 waves down and a decline to form intermediate wave A. And then we're going to be getting ready to enter into an intermediate B wave counter trend rally in bond price, decline in the yield. So there's the weekly chart. Now I'm going to break this down. Let's go down to the daily. And we can see that here's that minor wave 4. Now, what I want to start adding into this is I need to go up one more. I got to go back to my weekly chart. And so we've got minor. So I need this minor wave 1. And so I'm just going to start putting my fibs in to what could possibly be left for this bond to put in this final 5th wave. So now I'm going to come back down to the daily. And here again, we have 1, 2, 3, 4 working on a minute 5th of a minor 5th. So we're getting pretty close. So once again, I'm going to add my fibs, and these are just measuring these 5th waves. So we have all the way down now within the minute, we can go down to 107. So again, not really digging too much deeper. Now, let's stick with this one for a minute. And in the 30-year bond, it's been pretty dramatic, and we got a really strong sell-off, which is kind of what a lot of times you look for in that final, like, whoa, everybody out of the pool. And there was a lot of noise about the bonds and just what was, they started to collapse because of interest rates. And what we kind of saw was a decent bounce coming off of that. But again, now I'm going to come down to my 4-hour chart. And now we're inside this minor, and now we're inside this minute 5th wave. So we've got the minor 5th and now the minute 5th wave. And I can continue to count 1, 2, 3. It's an A, B, C. Now, there was the low of 3. I had marked it at October the 3rd, and that low was 109.20. And we spiked up, and then we slid real quick down. We came flying down on the 6th of October, and I'm not really remembering clearly what drove it, but I'm sure it was an economic number. And so down it came, and this one, it hit 108.29, which was actually a support level that could have completed the 5th wave. So, but what happened here in the 30 is that it kind of charged higher, got back up to 114. Actually, I got as high as, let me just get that number, 114.10, and that was on the 11th. So last Thursday, it hit that, did a nosedive immediately after, and dropped itself from 114, dropped back down to 111.20, and then just kind of hightailed it back up again. This all on Friday then, getting back to a high of 113.14 to finish out the day just below all that at like 112.31. So it's presenting a very, very difficult picture because let me go down to my hourly chart, and let's take a look inside this move. See, this move, in order for it to really kind of filter down, it needs to be 5 waves. So this is what I have going up, right? So I have the 3, and then we have what looks like an A, B, an A, B, and a C. So A, B, C. So it still appears to me that it's 3 versus a 5. This is a very quick slam dunk and then a recovery right off of. So right now I'm leaving it as the 3 is here, A, B, C, A, B, and then a C for wave 4. This doesn't count real cleanly, but it can be counted as 5 waves up. But then I get this, and then I get this. So again, what I'm working with here in the 30-year bond is the alternate. So I got 2 going. I'm leaving open the potential that we have 1 more drop, and that we get another slide lower, as we saw last week, as we saw on the 6th, that we get an additional, and we come down below 108.29. First up would be where the minute 5th wave would be 2.618. So 5 would be 2.618 of 1 at 107.16. Now beyond that, I have 100%, and that's at the minor degree level. So on the minute level, we have 107.16. On the minor level, we have equality at 104.15. Now, both have moved beyond their perspective. So in other words, on the minor, we did put in a new low below minor wave 3. On the minute, we did put a new low below minute wave 3. On the minuet, we did put a new low in below the minuet wave 3. Not all that much more, but we did do it, and then we rallied strongly off of it. So I've talked about this before, but I used in 10-year note then. Now I'm doing it in the 30. I'm leaving open the potential that the market can drop down. The alternate count heavily relies on the fact that the 3 is in place here. That's the 4, and we have an 8, and then a 5th wave down that completed there. There's many more times when you're using Elliott within the Treasury market, you're going to see, particularly now with a lot of the algorithmic trading, we see a lot more 3s where we think it should be 5. So again, this might be one of those circumstances where it did and then just kind of ran right up. But what kept it alive in terms of still needing a downside was doing it again on the 12th, doing it again on Thursday, bam, down on the CPI and the employment initial jobless claims, bam, drive it down. But the market turned off that low and rallied back up over a full percentage point. So it's still presenting an interesting picture in terms of we have to keep both sides alive. What's going to change it is if we break above 114. Then I'm kind of more convinced that that's going to be the low, and this was 1 and this was a 2, and we're breaking higher. So 2 things that I'm going to be looking for if that's the case. I'm going to be looking for the bond market to pick up the steam and just kind of get itself back up on 114, but not stop. Might pause, might look both ways before crossing, and then do it and end up being about 115 and 1 or up towards these levels. Now, I've not even put in what the expectations would be for an intermediate B wave countertrend rally again in the bond price and a decline in the yields. So because I'm waiting, and once I get the confirmation, then I will do so. But again, we have resistance at 114. We have additional resistance, I believe, about the 115 level. And then if it breaks above 116, I'm going to kind of call it a day, put my 5 in down here, and this is now working towards much, much, much higher levels in terms of the bond market. What does that suggest for rates? Well, the Fed has left open the strong possibility or the necessity to hike the rate one more time before the end of the year. Now, we're getting mixed signals from all, because we have the Fed governors, the Fed presidents, and they all get to sit down and make a decision, and that's coming up at the end of the month. So I think all of this back and forth and this volatility in the 30-year bond holds. Now, there's also a lot of talk about, the bond market, really normalizing itself somewhere between 5.25, 5.5, maybe even higher. Now, if that's the case where it sort of normalizes, well, we're going to get one more slam dunk, and then it's just kind of hang there. Because when they start pushing up the other thing that kind of is happening here is I believe there's a concerted effort to narrow this inverted yield curve. So in other words, pulling the 5 years up a little bit in rate, and the shorter end of the curve, they're trying to push it and bring it more closer together versus so inverted as it has gotten. Now, whether they're going to actually achieve that, I don't know. But I think we also saw last week where they had a 30-year bond auction and it didn't go very well. And that's, from what I understand, from a wonderful subscriber who told me, or told all of us, because they left it in a comment, that this was as a result of the 30-year bond auction, which did not go well. So in other words, it's like the foreign interest in our bond market was sorely lacking. They were not stepping in and willing to take these at the prices that were, or the rate that was being offered. So it was not a very solid participation. And I think a lot of it got placed within here, within the U.S. to resell to whomever, but it didn't go well. Now, is that a sign that we're going to have that one more hike? You wouldn't think so because of the way that they came back in afterwards. So again, trying to understand what is behind the type of trading that we're seeing. Why buy the bond up? Is it a mad dash grab because we don't believe that the interest rates are going to move that far away? So they're going to try to lock in a higher rate for that 30-year period? If we're really thinking that the bond market, that the prices are going to begin to rally, you're going to want to be long the bond. So again, are they looking into the future? Are they early? And we have one more slice down, which again, a lot of buying if you're institutional or if you're a hedge fund or if you're, a lot of these pensions, the pension plans, a lot of the groups or the players that will come in and they will take, a lot of banks will come in and place a 10-year note and they're going to keep it to maturity so they can take a 30-year note and they're going to hold on to it for that longer term if they really believe that interest rates are going to start to relax a little bit and come down versus go up. So there's a lot of risk in that, but at these levels, you have to think that the normalization might be 5.5, 5.75. But again, I'm looking that we're going to get an intermediate B wave counter trend rally in the bond price and decline in the rate. And that likely, since this took us 2 years to get to this point, it probably will take us at least 1.5 years or so, maybe 2, to unfold within that B wave. And so, yeah, you might want to just kind of lock in a decent rate while you watch the bond prices increase. You're in long the bond and you're getting a great coupon. So again, it's not a bad trade. So even if we want to say, oh, they're early, they're still going to come down, I don't think it's going to make that big of a difference to those traders. So they're going to be pretty happy with the prices that they get. So that's the 30-year bond. I want to take a quick look at the yield, which is also interesting. And let me just correct this and go down to a line. It's going to make it much clearer. So here again, it's the same type of a deal. It was an irregular 4, an irregular B wave. Again, went up, made just a slight new high above that. This is that high that I was talking about, 5.012, just stuck its little face above 5% and got whacked right back down. Came down in, so that's at ABC. And this low is actually a little bit more extended than I would have preferred. But then you could see on that bad auction, bam, come up. And then the day after, just knock it all the way back down. But it's kind of interesting because we've seen triangle patterns within yields before. We had one here with a fourth wave. So I don't know if this fourth wave is kind of rolling itself out in another triangle pattern, and then eventually is going to spike and get itself above 5%. So that also would cover that the bond price wavers just kind of up, down, wavers in below without really cruising up too high, without really kind of coming in, creating a new low as we put in this type of a move, again, for a smaller minuet fourth wave. Inside that minute fifth wave advance. So again, may take a while for this thing to unfold, but those are the choices that I'm kind of looking at right now. So whether this is the A, this is that kind of looks like 5 up, B, and then a C, I don't know. Is that going to be a B wave? Then we get a C wave, a D wave, an E wave, and then shoot to the moon. So maybe this takes a little bit longer and actually takes us to the end of the year or so. I don't know. And I'm not sure that it's even going to be a triangle. I'm just monitoring and watching. But the one thing that I continue to say is that I am looking for that low in the bond price and the high in the yield. And then to kick off with an intermediate B wave counter trend decline in the yields. So that B wave should be pretty strong, and we'll be able to get some numbers in once we start to see it kind of come in. Over in the 10-year note, it's actually the same story. Here's the 3, here's the 4. Let me just kind of get that over there a little bit so you can put it back in place. This is the 1 hour. I'm going to go all the way out to my weekly chart. And here we have the same deal. This was the high for the 10-year note. And that sits right there at 140. 10-year note, 140. So this is when we had basically zero interest rates, right? So the 10-year note reached a low rate of 0.69 or 0.7, maybe, 0.5% is what you got paid, buying a 10-year note at 140. Wow. That's pretty high. So off of that, now that's finished. So what we're looking for is an intermediate degree A wave to kind of come in. There'll be 5 waves of minor degree. And then I have 1, 2, 3, 4, and we're coming off here as well in the minor fifth, and we're down to the minute fifth. Now this one's a little bit cleaner in terms of what we have still, the 4th wave, and looking for that 5th wave down. Now, again, this is in the Treasury note. This is in the futures market. So let me bring it down to the daily. And here we've got the same type of a deal where we're seeing it go, well, that kind of looks like 5, right? 1, 2, 3, 4, 5. Is that an A, B? I don't know. So I'm more in tune. I'm more trusting here in the 10-year note that it may have completed. So in other words, I got to stick this 3 maybe up here, and then to get the 5, 3, 4, 5, and then 1, 2, 3, 4, 5, small 1, bing, 2. But I've got to leave it all open, because if I take it out of the line chart, put it back on the bar, we kind of get that A, B, C. Not as clean as all the rest. So it's still in line, but I'm leaving it open that we still have one last lower or just slide in note price, and we'll get a little bit of a rally to finish this thing in the yields. So if that's the case, what are we looking at? Well, this low was 106.035. We have first for minuet wave 5, 1.618 comes in at 105.185. Then for minute wave 5, 1.618 is 104.040. Minor wave 5 has actually come in. They've done the 100%. They've done, in between. The 1.618 is 101.105. Now, minor 5 is longer than minor wave 3. Excuse me. It's not the shortest wave. It has completed where it has gone below. This is what I really wanted to say. That's gone below minor wave 3. So it's made that new low. So anything down into here also finishes it. This actually could finish it. If I go out far enough, we're going to see that this low has exceeded that low. And that's what I was looking for to finish the move. So those requirements have been completed. Now, is to essentially what I'm looking at is like, is that going to be enough? Where's the rest of my? I have other 4 hour, but let me just try this one. So here again, we have, it didn't put in the new low, but it could be a B, and then we do it 5 waves up. Ugly as it is, but it does work. So this has a little bit better chance, and this again would be 1, a sub-minuet, wave 1, a sub-minuet, wave 2. We start to head lower, breaking back below the hourly 200 period, which is at 107.125. Break that low, which is 107.1040. Get through that and start heading towards this. Otherwise, the alternate does heavily suggest 1, 2, 3 again, but the 4 comes back. So it fits and it doesn't. So if need be, the whole thing, 1, 2, 3, 4, 5, 1, ABC, 2, and then we're still off to the races. So whether or not we make that new low will still keep open the potential that we will. But if we don't, then I'm going to move that 4 down to here. Actually, I'm moving the 3 up to here, the 4 there, and the 5 here. And this goes into a 1, 2, 3, 4, 5, finishing that first wave up. And that would be within the 10-year note. Now the yield, it's funny because the yields aren't moving quite as aggressively as the futures markets are, except here. Now, this came down and shot straight back up, but 4.5. It got as high as 4.8, almost 4.9. And I really do feel that the 10-year note's going to break 5. But it's going to take quite the push to get it there. But if we have it like we've seen in the past where we get these spikes, from here, it's got to spike and keep going. But, that was like the slide followed by, or the decline followed by that spike, followed by another decline. Are we going to rally back up again? So right now we have resistance at 4.687, 4.77, 4.905, and then a 5.123. That would be a target. That would be an ultimate target. Now, whether it gets there and they hold them up there, I don't think so. Because again, in an intermediate B wave decline, countertrend decline in the rate. So I just think it's going to last for as long as it takes that intermediate wave B to unfold. It'll unfold in a minor ABC. So got a lot to look forward to. And if you're a bond trader, if you like to trade in the bonds, it's almost time to go ahead and get long, either the note or the bond. And then just kind of ride the rate, while you have it, and benefit from getting in a low price for the Treasury note and watch the price rise as the yield comes down. Okay, so and they're all basically the same. I'm going to do a quick look at the 5-year. Let me open this up at least to the daily. See, we got the minor. We got everything, actually, the minor and the minute line up at the same level. So the 5's got a heavier weight here to kind of come down. This is actually coming up as 3. This is the daily chart. It looks pretty much like it's still a 3 waves. All right, let me come down. Let me bring this to my 4-hour and open this so we can see again. We have the 4 coming down, and that could have been it. That could have been it. But then we get that, and that's really kind of looking to me like it's a 3, being going to come down, maybe hit that 103.152 area. So we got 2618 for the minor, 2618 for the 5th, the minute 5th, minor 5th, minute 5th, bing. And maybe we're going to get another little tug lower as the minuet 5th kind of plays out. Does not necessarily have to, because it would, like the rest of them, it could be the strangest pattern we've seen, and they just start heading higher. So again, that's what I'm looking for. I'm looking for them to kind of start moving themselves back up off of these lows. Well, let me go back up and take a look at that weekly chart. Just 0.25%. 1, 2, 3, 4, 5, and they're really nice. They're just really what we look for. Bam, all the way down. So here, this looks even stronger. Like that could have been it. Like that 104.085 was it, and then we just kind of go from there. So that's the 5-year. Now I don't have a yield chart on the 5 or the 2. But I know that they're sitting above 5% still. Here's the 2-year note. It's less than 0.25% on the 2-year note at its high. Here we have it. 1, 2, 3, 4, boy, this kind of come in twice. But I think we still can get down to like par 0.237 or par 0.04. I think those are realistic. This is the weakest out of all of them as far as, but it's a 2-year, so the duration is it's such a shorty that it will react out heavier if we get another hike. Get down there, put that low in, and then that'll be it. All right, so that's where I'm going to stop here for the Treasury markets. I know there's a lot of people that think that this is an Elliott view. There's just been a whole lot of talk by respected fund managers, by respected hedge fund people in terms of interest rates and equities. And one of them that I particularly like was right here, and this is hedge fund billionaire Leon Cooperman, who is been doing this for a very long time, talks about interest rates, and you might want to check it out if you can pull up a story. He was interviewed by somebody, and he said, we are so fixated on inflation that they can't see the bigger danger and a potential fiscal crisis. Now that would, we could get ourselves into a fiscal crisis, and the way out of it is the way that the Fed has done it for such a long, long time. Float your way out. Just keep floating your way out. And fiscal crisis is going to come because we're in such a high level of debt. So got a lot of stuff out there that's brewing, percolating, whether the market wants to see it, whether they really want to factor it into a long-term picture. I think that way, if we have this intermediate A-wave bottom, we get a counter-trend rally, counter-trend decline in futures versus yield, but then we have an intermediate C wave, and that's going to be more destructive, folks, than this A wave. So that's all yet to come. I want to thank you for your time, and that's going to be it for today's podcast.